Welcome to another episode of Marketing School. I'm Eric Siu.
And I'm Neil Patel.
And today we're going to talk about if you should raise venture capital or not. So I have my thoughts around this, but Neil, you have raised, and most of your companies you have bootstrapped. So look, I think we kind of know the answer, but what would you do?
It depends. I still raise venture capital. I just closed, I think, like $1 million something this morning, and I'll go around trying to raise like 40, 50 million bucks. But I still raise venture capital. I believe if your idea is small and you're unsure of like how big it can be, don't waste your time raising venture capital. If your idea is huge and you're trying to swing for the fences and be a multi-billion-dollar company,
like Facebook,
yeah, it's hard to do it without venture capital. So, but in general, if you can get away without raising capital and you can give people equity or be more scrappy or figure out how to grow slower, I recommend that than raising venture capital.
Yeah, to Neil's point, I think it just depends on what you're trying to do. If you're like, look, if you're like SoftBank and you're trying to build this massive fund and you're trying to like invest in all these tech companies across the world and you have this really long-term vision, absolutely, raise money, go for it, right? Google, Facebook, for example, Tesla, these are all capital-intensive companies, and it just makes sense for them to raise. Now, on the other side of things, actually recently I listened to Rand Fishkin's book, the guy that founded Moz. And look, he got so diluted with Moz that, look, it ended up hurting him. There's a point in time where he could have exited for, let's say he got to exit for, 4x or get an 8x return on his money. It's great for him.
He actually said it in the book, right? What did he say his amount was? Like, he would have made at least 20 million or something like that, right?
I think it was like 25, 30 million, and this was not even counting the equity he would have gotten from HubSpot.
Yeah, he should have taken it.
He should have. So now he regrets not taking it. But what happened was, it wasn't a good return for his venture capitalists. The venture capitalists, usually, they don't want like a 4 to 8x return. They want like a 100x return. And they dissuaded him from taking that deal. So when you raise funds, especially the more you raise each round, you add a person to your board, well, what happens is they start to dissuade you. They start to look at their own interests, which is fine. They're investors. But that starts to kind of, take you in the wrong direction sometimes.
Yeah, the way I look at it as like if you have experience as an entrepreneur or you know where you want to go, you should really consider it. If your vision isn't clear and you just want to be an entrepreneur and you need some money to get by, it's terrible to raise venture capital. My co-founder of Crazy Egg, Ethan Shaw, he started a company called FYI. And I was telling him, I was like, hey, why don't you raise venture capital? Because there's so many people who want to throw money at him. And it's funny, a lot of these VCs are even putting it publicly online, like on Product Hunt, and being like, hey, I want first dibs. And when I was talking to Ethan, he was just like, look, unless I know how to use their money to grow faster, like specifically, he's like, I don't want it. I don't want to take money just for the sake of taking money. Because at that point, your exit possibilities are much smaller. You either have to go for a huge win or you're not really going to get one. So it's like, instead of just trying to take money so your life can be much more chill, think long run. Unless you know how you're going to spend that money to grow faster, not have some ideas or concepts, but really know where you're going to spend that money to accelerate your growth, don't take it.
Yeah, and plus, I mean, each quarter or so, you're going to have to report to the board. And the thing is,
it's monthly and for many startups, especially in the
even
early.
Even worse.
Yeah.
So the problem with that is like, you have to, when you raise another round, you're going to go on this cycle of having to raise more and more money. And sometimes it's gonna be hard for you to grow into that valuation. Sometimes you're gonna have to go with a down round, and you're gonna piss investors off, and you're gonna make people unhappy. So my opinion on this is that, look, all the stuff that we're teaching you on this podcast, Neil's built an audience. Like, we're building audience. I think what's important is building an audience first, and that way you have more leverage on your side. And down the road, maybe you've crystallized your vision a little more. Maybe you can go out and raise money, because by then you have a little more leverage over the investors.
Yeah, I had lunch, I would say like a month or two ago, maybe even 3-4 months ago. I don't know when it was. And I was in New York meeting up with these private equity guys. Their fund size is over $10 billion. That's billion with a B. And they were telling me, they're like, Neil, we would just love to invest in everything that you're doing. Like, we'd love to get you, money from us. And it was a substantial check amount. It wasn't like 10, 20 million. It was really large. And I told him, I was like, I don't want monthly meetings or quarterly meetings. I like working for myself. I don't like raising money when I don't have to. Now, yeah, there's certain projects where I'll raise money because I'm buying out businesses and I may not have enough cash flow myself. And, it's not easy to just be like, hey, let me write a check for $50-60 million to buy some of these businesses. So, like, I'll go and raise money in those cases. But in general, I hate raising money because it's a pain in the butt versus just working for yourself and being able to call all the shots.
Yeah, I think you got to go back to your vision. And I recommend reading this book called Vivid Vision. Is by Cameron Harold. I picked it up, and I'd say it's probably one of the most game-changing things I've done this year so far. But figuring out, like, what's important to you? Is it freedom? Is it becoming really famous? Is it just being a billionaire? Like, what is it? And I think freedom's certainly important to both Neil and myself. So think about that. Anyway, nothing from your side, right? You're good?
No, that's it.
All right, so go to singlegrain.com/giveaway to check out our marketing goodies, and we'll see you tomorrow.